model. I had a 750 credit score and I was broke. Say that out loud for a second. 750. That's not just a good score, that's an excellent score. Banks love that score. Lenders smile when they see that score. I used to screenshot it and feel something, like I had finally figured something out that other people hadn't. But my savings account told a different story. My investment portfolio, non-existent. My net worth, embarrassing for someone who had been working for years and doing everything right. The score said I was winning. The bank balance said I was running in place. I remember sitting down one evening trying to figure out where all the money was going. I had a decent income. I wasn't doing anything reckless. But every month felt like I was pouring water into a bucket full of holes and spending all my energy making sure the water looked good from the outside. Then it hit me. I wasn't managing my finances. I was managing my score. Every decision I made, every account I kept open, every balance I maintained, every card I used just to keep it active was made for the number. Not for me, not for my future. For a 3-digit measurement I had never once stopped to question. So I asked the question I should have asked years earlier. Who built this thing? Who decided what a good score looks like? And who actually benefits when hundreds of millions of people spend their entire financial lives chasing it? What I found changed everything. And that is exactly what this video is about. Let me take you back to what my financial life actually looked like during those years I was so proud of that score. I had 4 credit cards. Not because I needed 4 credit cards, because someone told me that having multiple accounts improved my credit mix. And that credit mix was one of the factors that determined my score. I was paying annual fees on 2 of them, cards I barely touched, purely to keep them open and protect my length of credit history. I had a car loan I could have paid off 6 months early. I didn't, because I had read somewhere that paying off an installment loan too early could actually hurt your score by closing a positive active account. So every month I kept sending interest to the bank, money I didn't have to spend. To protect a number, I was deliberately maintaining a credit card balance of around 10% utilization every month. Not because I couldn't pay it off, because the advice everywhere said that 0 utilization signals inactivity to the algorithm and can actually lower your score. So I was intentionally carrying debt, intentionally paying interest. To hit the sweet spot the system rewarded. Every single one of those decisions cost me real money. Monthly fees, interest payments, the opportunity cost of cash sitting idle instead of growing somewhere. And I made every one of those decisions not because they made my financial life better, but because they made my score look better. I was an unpaid employee of the credit system, doing maintenance work on their product every single month and calling it financial responsibility. Now let me show you where this whole system actually came from, because the history of the credit score is something most people have never been told. And once you know it, you cannot unknow it. Before 1989, there was no universal credit score. Individual banks and lenders made their own assessments about who to lend to. They looked at income, employment history, savings, the relationship you had with the bank. It was slow, it was inconsistent, and it did not scale well for an industry that wanted to lend to more people faster and with less friction. So a private company called the Fair Isaac Corporation, you know them today as FICO, developed a scoring model that could reduce a person's entire financial behavior down to a single 3-digit number. Banks adopted it almost immediately. It was fast, consistent, and it made lending decisions something that could be automated across millions of applications without a single human being looking at an individual file. But here's the thing that changes everything. FICO's clients were not consumers. FICO's clients were banks and lenders. The score was built to serve them, to predict how profitable a borrower would be, not to measure how financially healthy a consumer was. Those are 2 completely different questions with 2 completely different answers. A financially healthy person pays off debt quickly, avoids unnecessary borrowing, builds savings and investments, and reduces their total interest payments over time. A profitable borrower for a lender carries balances long enough to generate substantial interest, keeps multiple accounts open and active, and stays engaged with credit products consistently rather than paying everything off and disappearing. The credit score was built to identify and reward the second type of person, not the first. And if you look at the 5 factors that make up your FICO score, payment history, amounts owed, length of credit history, credit mix, and new credit, 4 of them actively require ongoing debt to score well. Length of credit history means old debt. Credit mix means multiple types of debt. Amounts owed means managed debt. New credit means recent debt. The only factor that doesn't explicitly require active borrowing is payment history. And even that only becomes meaningful if you have accounts to make payments on in the first place. The score was not built to reward your financial wisdom. It was built to reward your financial usefulness to lenders. And the genius of it, the thing that makes it one of the most effective systems ever built, is that it convinced hundreds of millions of people that those 2 things were the same. Now here's something that most people never find out, and this one made me genuinely angry when I first understood it fully. The credit bureaus, Equifax, Experian, and TransUnion are not government agencies protecting you. They are private corporations. They collect your financial data, package it, and sell it. They sell it to lenders who want to assess you. They sell it to employers who want to screen you. They sell it to insurance companies who use versions of it to set your premiums. And then they turn around and sell sell it back to you. You pay to see your own data. Data about you, generated by your own financial behavior, collected without you actively signing up for their service. And if that data contains error, which it frequently does with studies suggesting nearly 1 in 5 credit reports contains a material mistake, the burden of fixing it falls entirely on you, not on them, on you. The Consumer Financial Protection Bureau receives more complaints about credit reporting than almost any other financial category. Errors that take months and sometimes years to correct. Accounts that don't belong to the person whose report they appear on. Old debts reappearing after being settled. Entire financial histories that don't accurately reflect reality. And your ability to rent an apartment, qualify for a mortgage, get a job, or access affordable financing depends entirely on the accuracy of data maintained by 3 private corporations whose primary obligation is to their shareholders, not to you. This is where I want to tell you about my cousin Andre. Andre and I grew up together. Same family gatherings, same neighborhood, same conversations about money growing up, which mostly meant no conversations about money because nobody around us was talking about it in any meaningful way. We figured it out as we went, both of us. When Andre got his first credit card at 23, he called me excited. He had done his research. He knew about utilization. He knew about payment history. He had read everything he could find about building credit the right way. And for the first few years, watching his score climb felt like watching something work the way it was supposed to. By the time Andre was 28, he had a score above 700, 2 credit cards, a personal loan he had taken partly to diversify his credit mix, and a car on finance. On paper, everything looked strong. But one evening he called me and he sounded different. Not upset exactly, just quiet in a way that meant something was wrong. He had sat down and added up every monthly obligation he had. Car payment, minimum payments on both cards, personal loan installment, and when he looked at the total against his take-home pay, he realized that nearly a third of everything he earned every month was going directly to debt payments, not to savings, not to investments, not to anything that was building towards something, just to maintaining the financial profile that his score required. He was 28 years old, his score was 710, and he had less than $900 in savings. I didn't have a good answer for him that night because I was sitting in almost the same situation. 2 people who had done everything right. 2 people with nothing to show for it except a number. That phone call with Andre was one of the moments that pushed me to start asking harder questions because something was clearly wrong with the picture. We were following the rules exactly. The rules were not working for us. Here is what I eventually understood. The credit score doesn't just measure your behavior passively. It actively shapes it every single day through what I came to think of as the anxiety loop. Here is how the loop works. You want something, a home, a car, a better apartment, a business loan. You are told your ability to get any of it depends on your credit score. So you start managing your entire financial life around protecting that number. You keep accounts open you don't need. You hesitate before paying things off early. You feel that low-level anxiety every time your score moves a few points and you want to immediately do something to fix it. That anxiety is not accidental. That anxiety is the product working exactly as intended because an anxious borrower is an engaged borrower. An engaged borrower is an active borrower, and an active borrower is a profitable borrower. The score creates a psychological loop that keeps you perpetually focused on maintaining your relationship with credit products. And every month you stay in that loop, keeping accounts active, maintaining balances, paying those fees and interest charges the industry collects. I calculated once what my score maintenance had actually cost me over 3 years. The annual fees on cards I kept open but barely used. The interest on balances I maintained deliberately to hit the right utilization percentage. The opportunity cost of money sitting idle that could have been invested. The number was over $4,000. $4,000 not spent on building anything, not invested, not saved. Spent entirely on maintaining a score that a private company invented to help banks identify their most profitable customers. Now here's the part I promised you at the beginning. The thing the lending industry really does not want widely connected. The credit score and the credit card industry are not 2 separate systems that happen to coexist. They are the same system operating with 2 different faces. The credit score creates the anxiety that drives the behavior. The credit card captures the revenue that the behavior generates. One manufactures the demand, the other collects the money. And both were designed, refined, and deployed by the same industry to serve the same purpose. Think about how perfectly it works. The score tells you that utilization matters, so you keep balances. The card charges you interest on those balances. The score tells you that credit mix matters, so you open multiple account types. Each new account generates fees and interest. The score tells you that length of history matters, so you never close old accounts. Those old accounts continue generating annual fees for as long as you keep them open. Every piece of advice embedded in how the credit score works points directly toward behavior that generates revenue for the financial products built around it. Not one piece of advice embedded in the scoring model points towards saving more, investing consistently, or reducing your total debt burden. That is not a coincidence. That is architecture. Let me show you what this costs in real numbers, because this is where the conversation stops being abstract and starts being personal. The average person carries around $6,000 in credit card debt. At an average interest rate of 22%, that person is paying roughly $1,320 per year in credit card interest alone. Just interest, money that builds nothing, buys nothing, creates nothing. Just the cost of maintaining a balance that the score rewards them for having. Over 10 years, that is $13,200 paid directly to the credit card company. Gone. And here's the other side of that calculation that changes the picture completely. That same $1,320 per year invested in a simple index fund, earning an average 7% annual return, becomes approximately $18,000 over that same decade. So the real cost of carrying that average credit card balance, compared to investing that interest money instead, is a swing of over $31,000 over 10 years. From one habit, one decision repeated monthly for 10 years. And throughout that entire period, the person carrying the balance can have a perfectly healthy credit score, making payments on time, keeping accounts active, doing everything the system rewards, while losing $31,000 they will never see again. The score never shows the damage. It only measures the compliance. There is also something about the system that hits certain people harder than others. And I want to talk about it directly because it is real and it matters, and most finance channels never go near it. If you grew up in a household where your parents had no credit history, immigrants, people who operated in cash economies, people who were excluded from the formal banking system for any reason, you started this game without the advantages the system rewards most heavily. One of the fastest ways to build a strong credit score early in life is being added as an authorized user on a parent's old account. That account's entire history, sometimes decades of positive payment history, transfers directly onto your credit profile, instantly, legally, effectively. Wealthy families do this routinely for their children. It is one of the most powerful credit building tools available, and almost nobody who needs to know about it does. But it is completely inaccessible to anyone whose parents didn't have decades of clean credit history to share. The child of a family with established generational credit starts their financial life with a significant built-in score advantage over someone whose parents were excluded from the system through immigration, through historical banking discrimination, through poverty, through circumstances that had absolutely nothing to do with financial responsibility. The score presents itself as a neutral measure of individual behavior, but the starting line is not the same for everyone. And a system that measures behavior without accounting for the conditions that shaped that behavior is not neutral. It just looks neutral from a distance. Andre called me again about a year after that first conversation, but this time the energy was completely different. He had made some changes, not dramatic ones, not overnight, just a series of quiet decisions made one at a time over about 12 months. He had closed 2 credit accounts he didn't need. His score dropped about 35 points temporarily. He kept going. He paid off his personal loan 4 months early. His score dipped again briefly. He kept going. He stopped maintaining deliberate balances for utilization purposes and started paying his card to zero every single month without exception. His score stabilized, and his monthly cash flow increased by over $380 because the interest payments stopped completely. That $380 a month started going automatically into an index fund every month without him having to make a decision about it. He told me on that call that for the first time in years, he felt like his money was actually going somewhere, not just cycling through accounts and disappearing into fees and interest, actually going somewhere. His score was sitting around 705 when we spoke, down from the 710 he had worked so hard to achieve, but his savings had grown more in that 12 months than in the previous 4 years combined. He said something that I have not forgotten. He said, "I spent 5 years building a number for them. I want to spend the next 5 years building something for me." So what does actually managing your credit intelligently look like without letting it run your financial life? The first thing is the simplest and the most powerful. Pay every bill on time every single month without exception. Set up automatic payments and remove human error from the equation entirely. Payment history is the largest single factor in your score, and it costs you nothing beyond basic organization. This one habit alone builds and maintains a functional score over a lifetime without demanding anything complicated from you. The second thing is keeping 1 or 2 credit cards and using them deliberately, not primarily for the score, for the genuine practical benefits they offer. Purchase protection, fraud protection, the float period between spending and payment. Use them for small, regular purchases. Pay the full balance every single month. Never pay a single cent of interest. This keeps your profile active, gives you the real-world utility of the product, and costs you absolutely nothing. The third thing is releasing the anxiety around everything else. The third and fourth cards kept open purely out of fear of what closing them will do to a number. The loan not being paid off because of the score impact, the utilization percentage being managed like a second full-time job. That anxiety is expensive. The mental energy it consumes is worth more redirected elsewhere. A score of 700 that you never think about serves your life better than a score of 790 that costs you thousands of dollars a year to maintain. And the fourth thing, the one that actually changes the trajectory of your financial life, is redirecting your attention toward numbers that genuinely determine your future. Your savings rate, your investment balance, your net worth growing month over month, your total monthly debt obligations as a percentage of your income. These are the numbers that determine whether you have real options when life presents opportunities or emergencies, whether you can leave a job you hate, whether you can handle a crisis without being destroyed by it, whether you retire when you want to or when you are forced to. A 680 credit score with $45,000 invested and no credit card debt is a fundamentally stronger financial position than an 800 credit score with $500 in savings and $9,000 in revolving balances. One of those people has freedom, real freedom. The other has a number that makes lenders comfortable. Here is what I want to leave you with. At some point in your life, someone handed you a credit score and told you it was your financial report card, and you believed them, because why wouldn't you? It was presented as official, as important, as the number that determined your access to the life you wanted. Your financial worth is not a 3-digit number maintained by a private company whose clients are banks. Your financial health is measured in what you own, what you owe, what you have built, and what options you have when life gets difficult. None of those things appear on a credit report. So here's your one action this week. Go to your actual credit report, not the score, the full detailed report, and look at every single open account listed on it. Next to each one, honestly write down what it costs you annually in fees or interest. Then ask yourself one question for each account. Am I keeping this because it genuinely serves my financial life, or because I am afraid of what closing it might do to a number? That question has an answer. And once you hear yourself answer it honestly, you will know exactly what to do next. Andre stopped chasing the number, started building the life. The results spoke for themselves. Now it is your turn. Stop managing their number. Start building yours.